Welcome to Griffonomics. Today we're diving into the Home Depot, trading under the ticker HD. Home Depot is aggressively pivoting from consumer big box retail into commercial wholesale distribution, SRS GMS, to capture market share in a historically frozen housing cycle. However, underlying top-line growth remains entirely dependent on ticket inflation while customer transactions contract, and headline gross margin expansion was artificially shielded by temporary tariff refunds that will roll off into rising commodity and freight headwinds.
Yeah, that thesis really lays out the whole conflict right there, because if you just glance at the headlines, it looks like a total different story.
Right. I mean, the mission of this deep dive, and welcome to anyone listening, we are so glad you're here, is to separate those headline illusions from the actual fundamental reality of the business.
Exactly. We have to tear down the numbers.
Because it's honestly like they're playing chess on two totally different boards at the same time. They're trying to keep the everyday retail consumer engaged on one board, while on the other, they're quietly building this massive commercial wholesale empire.
Right. And to really understand that pivot, we have to forensically dismantle their Q2 2026 earnings. We need to see what's actually driving the cash flow versus, that's just an accounting anomaly.
Oh, let's start with that surface level reaction.
Yeah.
Because Wall Street loved this at first glance, didn't they?
Oh, they absolutely did. The initial reaction was, it was almost blindly optimistic. If you just scan the press release, it paints a picture of total resilience.
Right, because the top line numbers look massive.
Yeah, exactly. We're looking at a company that just reported net sales of $47.86 billion.
Wow.
Right. That's a 5.7% increase year over year. And that beat the consensus by a massive $660 million.
Which is a huge beat for a retailer of that size.
It is. And then you look at total comparable sales, which is, the golden metric for any retailer. Comps rose 1.7%, and the street was only expecting 0.94%.
So they essentially doubled the expectation on comps.
Pretty much. And then flowing that down to the bottom line, GAAP diluted earnings per share hit 4.79, and adjusted diluted EPS landed at 4.92.
Okay, so that adjusted number, that's up, what, 5% year over year?
Up 5.1%, beating the street consensus by a full 19 cents.
See, in reading that, any casual observer would think the American consumer just suddenly woke up, shook off the inflation hangover, and decided to renovate their entire house.
Right. The stock saw a pre-market relief pop of almost 2% based on that exact narrative.
Yeah, the headline narrative is basically, hey, the worst of the housing freeze is over. But, the deeper we go into the geographic and the sequential data, the more that narrative feels like, I don't know, just a statistical mirage.
And mirage is a really good word for it. Let's look at how those numbers broke down month by month.
Let's do it.
So U.S. comparable sales were up 1.3%, but management heavily promoted this idea of sequential acceleration throughout the quarter.
Right. They were really pushing that on the call.
Yeah, because in May, comps were sitting at positive 1.2%, then June climbs to positive 1.5%, and then July suddenly spikes to 2.3%.
Okay, wait, 2.3% in July. That July spike seems to be the linchpin of the whole bullish argument right now.
It absolutely is. Now, you also have to factor in that Canada and Mexico actually outcomped the total company.
Oh, really?
Yeah, and there was a 25 basis point benefit just from favorable foreign exchange rates.
Okay, so FX is giving them a little bump.
Right, but even stripping away the international boost and the currency luck, that U.S. acceleration from 1.2% to 2.3% over 3 months, that's what caught everyone's attention.
Because the natural assumption is that consumer sentiment is thawing out, right?
Right.
Along with the summer weather.
Exactly.
But wait, I have to stop you there. Because reading through the transcripts, that July jump, it isn't an organic shift in consumer behavior at all.
No, it's not.
Right, because my first instinct looking at a 2.3% comp in July is that, okay, big ticket discretionary spending is back, people are buying lumber, but are you telling me this massive multi-billion-dollar company's stock popped because people were literally just hot for exactly 1 week?
That is the mechanical reality of year-over-year retail comps.
That's insane.
It is. When you listen to the earnings call, the executive VP of merchandising, Billy Bastick, he had to admit what actually drove that volume.
And what was it?
A severe 1-week heat wave shifted on the calendar.
Just 1 week?
Yep. In fiscal 2025, that heat wave hit in late June, but in fiscal 2026, it shifted into July.
So wait, we aren't seeing families deciding it's finally time to pull a permit and build a backyard deck.
Not at all.
We're literally just looking at a panic buying spree for portable air conditioners.
Pure duress purchasing. I mean, when that heat wave hits, people rush the stores for AC units, box fans, hydration products, heavy-duty extension cords.
To try not to melt.
Right. And because that specific week fell in June last year, June of this year faced an incredibly tough year-over-year comparison. And July of this year received an artificial mathematical boost.
Wow.
Yeah, management even stated that if you strip out the financial impact of that single AC-driven week, the underlying sales trend for May, June, and July was completely flat.
Completely flat. So there was literally zero acceleration.
None. Zero.
Which completely invalidates the headline narrative that the consumer is gaining momentum. I mean, if you're a listener managing your own portfolio and you're just looking at month-to-month acceleration trends in a vacuum, you might look at that 2.3% and think it's time to heavily allocate capital into the home improvement sector.
Right, and you'd completely miss that you are essentially trading on a retroactive weather forecast.
That's a brilliant way to put it, trading on a weather forecast.
And this is exactly why forensic accounting is mandatory. If the top-line revenue beat was subsidized by a weather anomaly and currency fluctuations, our immediate next step has to be interrogating the profitability of those sales.
Yeah, we have to look at the gross margin because from our prep, that is where the most significant accounting illusion of this entire quarter is hiding.
It really is. So let's tear into that margin.
Okay, so the headline Q2 gross margin expanded by 25 basis points to reach 33.7%. And I mean, in a retail environment where everyone is constantly complaining about shrink, theft, supply chain costs, a 25 basis point expansion looks like operational genius.
It looks fantastic on paper.
But the reality is they got handed a massive one-time government windfall.
Yes, they did. Home Depot received $730 million in IEPA tariff refunds in late June.
Okay, IEPA. Break that down for us.
So that stands for the International Emergency Economic Powers Act. And the mechanics of this refund are crucial to understand. This isn't operational revenue from selling hammers.
Right.
This is a retroactive reimbursement for tariffs that Home Depot had previously paid on imported goods.
Okay, so they essentially got a refund check from the government.
Exactly. And when that $730 million check cleared in late June, the accounting rules required them to recognize it immediately.
So how did they apply it?
They took $685 million of that refund and used it to directly reduce their cost of goods sold, or COGS, for the second quarter.
Wait, just for that one quarter?
Yep. And the remaining $45 million stays tied up in inventory to be realized in future quarters.
So mechanically, if you artificially slash your cost of goods sold by almost $700 million in a single 90-day window, your gross margin is just going to look spectacular on paper.
It creates a massive distortion. That $685 million COGS reduction provided a 145 basis point benefit to their gross margin.
Okay, let's do the math on that for a second. If the headline margin only expanded by 25 basis points.
Right.
But they received a 145 basis point artificial boost from a refund check.
You see where this is going.
That means the core underlying business is actually bleeding margin. Without this one-time tariff credit, their gross margins faced 120 basis points of severe pressure.
Severe pressure. The underlying business is fighting a brutal war on input costs right now.
Where's that pressure coming from specifically?
That 120 basis points of pressure breaks down into two distinct buckets. First, you have a 60 basis point hit from unplanned inflation.
Like raw materials.
Yeah, the physical materials required to operate and stock the stores. We're talking diesel fuel for the logistics fleet, grid energy to keep the lights on, resin for manufacturing plastics, and industrial metals.
Right, the stuff that makes everything run.
Exactly. And then the second 60 basis point drag came directly from a mix shift due to their recent acquisitions. Specifically the GMS acquisition, which naturally operates at a structurally lower margin profile than their traditional consumer retail side.
It's just wild. I mean, using this one-time tariff credit to mask operational inflation. It's like finding a $20 bill or, well, a massive, unexpected tax refund check in the mail on the exact same day your car's transmission explodes.
That's a great analogy.
Right. Like you used the check to pay the mechanic. You didn't actually generate any new wealth. You just got incredibly lucky with the timing of the windfall to cover a catastrophic, unplanned expense.
Or just plug in a hole.
But that brings up a terrifying prospect for the rest of the year. If they don't have another $700 million refund coming in Q3, aren't they walking entirely unprotected into an inflation buzzsaw?
They absolutely are. And their chief financial officer, Richard McPhail, he basically confirmed this during the Q&A with analysts from UBS and Gordon Haskett.
What did he say?
He admitted that the margin expansion we saw in the second quarter will likely reverse because that tariff offset will not repeat.
Because it was a one-time check.
Right. They booked the cash when it arrived, which made Q2 look resilient. But the underlying fuel, energy, and commodity inflation hasn't gone away.
So they're going to feel that full 120 basis point drag soon.
Yeah, McPhail guided that by Q4, margins are expected to just flatten out year over year. The tariff refund was literally just a temporary shield.
And the pressure isn't just coming from raw commodities either, is it? We also have to look at how shifting geopolitical trade policies are acting as a margin squeeze.
Oh, for sure.
Because the sources highlight the expiration of Section 101 tariffs and the transition to Section 301 tariffs as incremental, unforecasted pressures. How do those specific trade mechanisms actually hit a retailer's bottom line?
Okay, so Section 301 tariffs, they allow the U.S. government to impose duties on foreign countries, primarily China, that are deemed to be engaging in unfair trade practices.
Right.
When the administration transitions from previous tariff structures or, allows certain exemptions to expire, the immediate financial burden falls on the importer of record.
Which in this case is Home Depot.
Exactly. Home Depot imports massive quantities of hardware, lighting fixtures, seasonal decor, hand tools.
Stuff they sell every day.
Right. And when a 25% tariff is suddenly slapped on a shipment of power drills sitting at a port in Los Angeles, Home Depot has to pay that duty to clear customs.
And then what? They just eat the cost.
Yeah. Well, they have a choice. They can absorb the cost and destroy their own profit margin, or they can pass the cost onto the consumer by raising the price of the drill on the shelf.
Which brings us perfectly to the actual health of the consumer walking into the store.
Exactly.
Because if Home Depot is forced to pass those inflationary costs down, as a listener, we need to know how the buyer is reacting to that.
Yeah.
And the data shows they are flat out rejecting the higher prices.
Yeah, the volume is dropping.
Comp transactions like the actual physical volume of purchases being made fell by negative 1.0%. Total transactions dropped 0.8% down to 443.2 million. So fewer people are shopping, and they're buying fewer items when they do.
Right.
Yet somehow the average ticket size rose 2.8% to $92.50.
And this is the mechanical definition of ticket-led growth. The revenue isn't increasing because they are moving more physical volume through the supply chain.
It's purely price.
Purely price. The revenue is increasing because the price tags on the shelves have been marked up and because of very specific non-discretionary trade-ups.
Our sources refer to this as the middle-of-the-store phenomenon.
Yeah, that's exactly what it is.
Because out of 16 merchandising departments at Home Depot, 13 actually comped positive. But it's all the gritty, unglamorous necessities. We're talking plumbing, electrical, pipe fittings, basic hardware.
The stuff you have to buy.
Right. Conversely, the discretionary, big-ticket, financed remodels, the $40,000 dream kitchens and the luxury bathroom, those are completely dead.
Just completely flatlined. And it reveals a massive shift in consumer psychology and credit availability. To truly understand this, we have to contrast Home Depot's performance with Walmart's Q2 results.
Oh, this is a great comparison. Let's do that.
So Walmart just reported a 2.6% increase in U.S. comparable sales, but their growth composition is the exact inverse of Home Depot's.
Because Walmart is actually getting more people in the door.
Right. Walmart's growth was driven by a 1.5% increase in physical transaction volume, more foot traffic, and only a 1.1% increase in ticket size.
And the most telling detail from Walmart's earnings was their demographic data, because they specifically noted market share gains driven by trade downs from households earning over $100,000 a year.
That's the key. Walmart is aggressively playing a volume game right now. They rolled back prices on over 11,000 items to intentionally capture that budget-conscious consumer.
While Home Depot's doing the opposite.
Yeah, Home Depot is attempting to sustain its top-line growth purely through higher average tickets on non-deferrable items, all while actively bleeding physical foot traffic.
Think about the mindset of that $100,000 a year household for a second. If a family is purposely deferring a kitchen remodel to save cash, and they're actively choosing to buy cheaper bulk groceries at Walmart instead of their usual premium supermarket, they are in a defensive crouch.
Absolutely. They are protecting their cash.
So when that same family walks into Home Depot to buy a $300 toilet, they aren't doing it because they feel wealthy and want to upgrade their bathroom aesthetics.
Hmm.
They are buying the toilet because the old one shattered and they literally have no other choice.
Yeah.
That is a hostage consumer, not a healthy one.
The technical term is non-discretionary, break, fix, maintenance. And for anyone managing a retail portfolio right now, this trade-down phenomenon is the classic signature of a late-cycle consumer.
Because they're only spending on emergencies.
Exactly. When you see capital outlays rotating violently away from specialty retail and structural renovations and moving strictly toward low-cost staples and emergency repairs, you know the discretionary budget is tapped out.
So if the traditional DIY consumer is tapped out, pulling back on massive projects, and treating Home Depot like an emergency room for their plumbing, where does a $350 billion company find its next phase of hypergrowth?
That is the big question.
Because they can't just keep raising the price on plungers to satisfy Wall Street, right? They have to find an entirely new customer base.
And that brings us to the most aggressive and frankly fascinating strategic shift in the entire retail sector right now.
The B2B pro war.
The B2B pro war. Because management can read the exact same consumer health metrics that we are analyzing. They know the DIY retail well is running dry.
So they're pivoting.
Hard. That is why they are engineering a multi-year pivot away from consumer big box retail, and they're aggressively building a commercial wholesale distribution monopoly.
We need to map out the sheer scale of this battlefield. Because Home Depot didn't just, tweak their marketing to target contractors. They deployed massive capital.
Unbelievable amounts of capital.
They acquired SRS Distribution for $18.25 billion.
Which is huge.
SRS is a titan in the roofing and building envelope sector. Then they followed that up by acquiring GMS for $5.5 billion, a company that dominates the commercial drywall and interior finishing market.
These acquisitions fundamentally alter Home Depot's competitive identity. I mean, historically, their Tier 1 competitors were Lowe's, Menards, maybe Ace Hardware.
Traditional retailers.
Exactly, traditional retailers fighting for suburban foot traffic.
Yeah.
But by acquiring SRS and GMS, Home Depot is bypassing retail entirely. They are entering Tier 2 and Tier 3 warfare against pure-play commercial wholesale distributors.
They are picking fights with specialized giants. I mean, they are now going head-to-head with Builders FirstSource, ticker BLDR, which practically owns the national production home builder packages for structural framing and lumber.
Yep.
And they are stepping into the ring with Brad Jacobs QXO, which is currently orchestrating a massive roll-up of the fragmented commercial roofing and insulation markets.
The question is how a retailer, even a big one, competes against established industrial wholesalers.
Right, because it's a totally different logistics model.
It is. But the answer lies in the structural moat Home Depot is building by combining their assets. Think about it. A pure-play distributor like Builders FirstSource relies entirely on a network of standalone warehouses, lumber yards, and branch distribution centers.
Usually out in industrial parts, right?
Exactly, outside the city limits. But Home Depot, they're combining their 2,360-plus retail stores with the 3,340 specialized branches they just acquired from SRS and GMS.
Taking on this debt to buy SRS and GMS.
Yeah.
It's like a factory owner borrowing money to buy their own supply chain. It's expensive up front, but it completely changes the logistics game.
Totally.
You're basically turning every local neighborhood Home Depot into a localized distribution hub for massive commercial jobs.
And the integration mechanism for this strategy is a proprietary retail system they call QuoteCenter.
Okay, tell me about QuoteCenter.
So Home Depot has now activated QuoteCenter in 90% of their retail stores. What this does is it takes the massive, highly specialized commercial catalogs of SRS and GMS and makes them fully accessible at the standard retail pro desk.
Let's explain mechanically how revolutionary this is for a contractor. Because before this integration, an independent commercial roofer had to manage a split logistics chain.
Right. Is a nightmare.
They had to go to an industrial wholesale branch to order a massive flatbed delivery of architectural shingles. But if they forgot a specific brand of nail gun or needed emergency safety gear, they had to drive across town to a retail store.
Wasting time and money.
Exactly. Now, that same contractor can walk into a normal Home Depot, use a dedicated SRS purchase card to grab a power tool off the shelf, and while standing at the register, use QuoteCenter to schedule a boom truck delivery of commercial-grade drywall directly to their job site from a GMS branch 50 miles away.
It removes all the friction from the commercial procurement process. I mean, management believes this integration alone unlocks an immediate $400 million cross-sell run rate.
Just from making it easier to buy.
Yeah. But the true weapon of this B2B war is the logistics dominance. By integrating the SRS and GMS delivery assets with their own, Home Depot now commands a fleet of nearly 8,000 trucks.
And these aren't just UPS box trucks dropping off packages.
No, no.
We're talking about heavy-duty flatbeds, Moffett forklifts, and boom cranes required to lift pallets of drywall into second-story windows. But they're also dominating the speed of the smaller immediate needs too, right?
Yeah, the sources note their sub-3-hour express delivery is rolling out nationwide. And the crazy part is, the majority of those deliveries are actually fulfilling in under 1 hour.
Under 1 hour to a job site? That's incredible.
And they are aggressively layering artificial intelligence over this physical footprint as well. The transcript details an in-store AI tool called Magic Apron.
Magic Apron.
Yeah, it's already processing millions of queries a month. Instead of a store associate spending 2 hours trying to manually build a complex project material list for a contractor, the AI instantly navigates the localized inventory of both the retail store and the surrounding wholesale branches.
It just builds the list for them.
It generates the list and optimizes the delivery routing all instantly.
Home Depot is using its massive retail footprint as a Trojan horse. They capture the contractor's emergency fill-in trips at the store level, and they use that physical touch point to capture the massive palletized job site drops that used to go exclusively to Builders FirstSource.
That's exactly what they're doing.
They are positioning themselves to be the single source of truth for the entire commercial construction industry.
It is a brilliantly executed strategy, but we have to zoom out and address the macroeconomic elephant in the room here.
Which is the housing market itself.
Right, because Home Depot can build the most efficient wholesale flywheel in the world. But if the end market is paralyzed, those 8,000 trucks are just going to sit idle.
Yeah, there has to be demand.
And this company is currently operating in a fundamentally broken housing environment, which forces us to analyze the macro stalemate and the political interventions attempting to fix it.
The housing market right now isn't just slow, it is functionally frozen. Housing turnover, and the metric measuring the rate at which existing homes are bought and sold, is stuck at a 40-year low.
A 40-year low.
For 4 consecutive years, only about 3% of the total U.S. housing stock has turned over annually.
And the mechanics behind this freeze are entirely driven by the lock-in effect.
The golden handcuffs.
Exactly. Over the last decade, particularly during the zero interest rate environment, millions of Americans locked in 30-year fixed mortgages at sub-4% rates. Currently, there are roughly 85 million homeowners sitting on these historically cheap mortgages.
If that homeowner wants to sell their house to upgrade for a growing family, they are forced to surrender that 3% mortgage and take on a new loan at current market rates, which have been hovering around 6.5 or 7%.
Which is brutal.
The math completely destroys their purchasing power, so they simply refuse to move.
And that lack of mobility is exactly what starves Home Depot of its most lucrative revenue stream. The highest margin, highest volume material purchases occur during mover-driven events.
When people are actually changing houses.
Right. When someone buys a new home, they immediately spend 5 figures remodeling the kitchen or the bathrooms to fit their taste. And when someone prepares to sell a home, they do the same thing to maximize the listing price.
So a frozen housing market means those structural big-ticket renovations just vanish.
They disappear entirely.
This macroeconomic paralysis is so severe that it has actually triggered a direct response from Washington. And we need to audit the Trump administration's executive actions that are explicitly aimed at unfreezing this market.
We do.
And I want to be perfectly clear to you, our listener. We are looking at this through a strictly impartial financial lens. We're not analyzing the politics. We're analyzing the mechanical policy levers being pulled and how they dictate Home Depot's operational reality.
Exactly. We're just looking at the mechanics. And the administration is attacking the housing freeze from multiple angles. On the supply side, they are deploying executive orders focused on aggressive deregulation.
Okay, so cutting red tape.
Right. They are directing federal agencies to issue NEPA exemptions, that's the National Environmental Policy Act, and pushing for significant rollbacks in the Clean Water Act.
And what's the mechanical goal there?
To drastically reduce the permitting timelines and the regulatory costs associated with building new residential communities and the utility infrastructure required to support them.
Speeding up the actual building process.
Exactly. They are also intervening on the demand side, specifically targeting institutional investors. They are attempting to curb large private equity landlords from bulk buying single-family residential inventory.
Oh, to keep houses in the hands of individuals.
Yes. The strategy is to preserve the limited supply of starter homes for traditional individual consumers, because historically, those consumers drive much higher volumes of DIY material purchases at retail stores compared to institutional property managers who just source materials at scale.
That makes perfect sense for Home Depot's retail side. But the most powerful lever the administration is attempting to pull, the ultimate catalyst for the entire building sector, is the GSE liquidity mandate, right?
Oh, without a doubt.
They are directing the government-sponsored enterprises, Fannie Mae and Freddie Mac, to purchase $200 billion in mortgage-backed securities, or MBS.
This is the big one.
We need to explain exactly how that $200 billion mandate mechanically lowers the mortgage rate for, say, a family trying to buy a house in Ohio.
Okay, so think of a mortgage-backed security like a bond that pays a yield based on the mortgage payments of thousands of homeowners.
Okay.
Bond prices and bond yields operate on an inverse seesaw.
Right, they go in opposite directions.
Exactly. If a bond pays a fixed dividend of $5 a year and you buy the bond for $100, your yield is 5%. But if the government suddenly rushes into the market and buys up massive quantities of those bonds...
That surge in demand drives the price of the bond up.
Right. So say the price goes up to $150. That same $5 payout is now a much smaller percentage of the $150 price tag. The yield has been mathematically forced down.
So, by forcing Fannie and Freddie to buy $200 billion worth of these securities, the government is artificially driving up the price of the MBS, which instantly compresses the yield.
Yeah.
And because consumer mortgage rates are directly tied to those yields, the 7% mortgage rate is dragged down toward a target threshold of 5.5 to 6.0%.
And that 6.0% threshold is the magic number.
Why 6.0?
Industry analysts widely consider 6.0% to be the psychological and mathematical breaking point for the lock-in effect. Every 100 basis point reduction below that level releases a flood of pent-up mover demand.
When people finally start moving, they start renovating.
Exactly. Furthermore, if the deregulation efforts successfully shorten the commercial construction cycle by 3 to 6 months, Home Depot's B2B logistics network, all those SRS and GMS trucks, they directly benefit from the faster project velocity.
But let me challenge the timing of this entire thesis for a second.
Sure.
Because even if the GSE mandate works flawlessly and rates drop to 5.9% tomorrow, and even if NEPA exemptions clear the red tape, the physical world moves slowly.
Very slowly.
You cannot simply flip a macroeconomic switch and have cranes in the air and foundations being poured the next morning. If the policy triggers tomorrow, how long until Home Depot actually sees the cash hit the register in their plumbing and millwork departments?
That lag effect is the greatest risk to this thesis, honestly. You are looking at a minimum 6 to 9 month delay before a positive macro inflection translates into realized revenue.
6 to 9 months of just waiting.
Right. I mean, the Architecture Billings Index, which is a leading indicator tracking the design phase of commercial construction, has been contracting for over a year. The blueprints haven't even been drawn yet.
Which means we are looking at a prolonged waiting game. And that forces us to look at how Home Depot is managing its balance sheet right now. Can they afford to sit in the cold and wait for the housing market to thaw out?
To answer that, we really have to audit their capital allocation and their FY 2026 guidance.
Let's do it.
From a pure cash generation perspective, they remain an absolute juggernaut. In the first half of the year, operating cash flow reached $11.42 billion.
Wow. And they are aggressive about deploying that cash back to shareholders and into their infrastructure, right?
Very aggressive. They funded $4.64 billion in dividends, providing a yield of roughly 2.8%.
Okay, so paying the shareholders to wait.
Exactly. They also allocated $1.72 billion to CapEx, which is tracking at about 2.5% of total sales. That's funding the QuoteCenter tech, the Magic Apron AI, and supply chain maintenance.
But the danger lies in the debt burden they took on to build this B2B empire, doesn't it? Because acquiring SRS and GMS pushed their long-term debt to a staggering $48.65 billion.
That's a massive amount of leverage.
Now, I know I said earlier that buying SRS was like a factory buying its own supply chain, which is a smart long-term move. But servicing nearly $50 billion in debt while physical foot traffic is actively shrinking, that is a massive near-term liability.
It's definitely a tightrope walk.
Can their operating cash flow actually handle the interest payments if this housing freeze lasts another 2 years?
They can service the debt, yes, but it actively destroys their capital efficiency.
How so?
Well, that massive debt load pulled their trailing return on invested capital, or ROIC, down from a stellar 27.2% last year to a much heavier 24.8% this quarter.
That's a noticeable drop.
It is. And more importantly, that debt generates $2.3 billion in annual net interest expense.
Just an interest.
Just in interest.
Yeah.
That is $2.3 billion in cash that vanishes before it can ever reach the bottom line or be returned to shareholders.
Which perfectly explains why management is taking such a defensive posture with their FY 2026 guidance. Despite the headline narrative of July comps accelerating to 2.3%, management reaffirmed their full-year guidance at incredibly muted levels.
They played it very safe. Let's parse exactly what they guided. They project total sales growth between positive 2.5% and positive 4.5%.
But wait, doesn't that include the acquisitions?
Exactly. You have to remember that includes the inorganic, bolted-on revenue from the GMS acquisition and the physical opening of new store locations.
Oh, it's not organic growth.
Right. When you look at their comparable sales guidance, the organic health of the existing locations, they expect it to remain completely flat to a maximum of positive 2.0%.
Wow, flat to 2%. They also guided their gross margin to settle at approximately 33.1%, adjusted operating margin between 12.8% and 13.0%, and adjusted EPS to be anywhere from flat to positive 4.0%.
And by heavily reaffirming that muted guidance, right after delivering a Q2 beat that was heavily subsidized by a $685 million tariff refund, management is flashing a massive warning sign to institutional investors.
They're saying don't get used to this.
Exactly. They are explicitly confirming that severe second-half margin compression is inevitable. The tariff credits are expiring, and they will be forced to absorb the rising costs of fuel, resin, and metals organically.
And they still have that debt to pay.
Right. They know they will be paying $2.3 billion in interest every single year while waiting for Washington policies to unfreeze the housing cycle.
So we have to bring all of this together. We've forensically dismantled the tariff illusions, we've mapped out the massive B2B wholesale pivot, and we've analyzed the macro policies trying to save the housing market. What is the concrete playbook for you, the listener, managing your own capital?
The ultimate verdict requires you to answer one really important question.
Which is?
Is Home Depot a defensive cash fortress you can hide in during a downturn? Or is it a rate-sensitive value trap that will drag down your portfolio?
Our sources suggest it is basically a story of two different timelines.
Yeah.
In the near term, like the next 6 to 12 months, multiple expansion is severely capped.
Sure, be capped.
The stock will struggle against high borrowing costs, contracting physical foot traffic, and the margin compression coming in Q3 and Q4.
But structurally, if your time horizon is 12 to 36 months, the narrative flips completely.
Because of the B2B side.
Right. Home Depot is utilizing this exact cyclical trough to aggressively build a wholesale distribution monopoly that their pure-play retail competitors simply lack the balance sheet to replicate.
Lowe's can't do this.
No, they can't. When the housing market finally unfreezes, Home Depot will own both the DIY consumer retail channels and the commercial heavy logistics pipelines.
Which dictates a very specific tactical sizing protocol. The playbook suggests maintaining a 2% to 6% position size within your broader equity allocation.
And the execution of that sizing requires extreme patience. You cannot chase the stock on post-earnings momentum pops, especially when it breaks above $350.
Because it's just going to come back down.
Exactly. The technical setup shows the stock is trapped in a range-bound consolidation corridor. The strategy is to accumulate shares in 50 to 150 basis point tranches, specifically targeting dips toward major support levels that currently sit between $310 and $325.
So you essentially buy the structural B2B moat at technical support, and you collect that 2.8% dividend yield to pay you while you wait for the Trump administration's policies and falling mortgage rates to trigger the macroeconomic housing inflection.
That's the play.
CFO Richard McPhail specifically referred to 2026 as a clean jumping-off point into 2027. They are choosing to absorb the pain right now, absorbing massive debt to take market share, so that the exact second mortgage yields drop and housing turnover normalizes, the logistics network possesses maximum operating leverage.
That is the crucial takeaway. This isn't just a retail stock waiting for consumers to feel richer. It is a logistics and distribution empire positioning itself for a cyclical supercycle.
We covered an immense amount of ground today. I mean, we didn't just accept a top-line beat. We audited the $685 million tariff refund that artificially inflated their gross margin.
We really dug into it.
We proved that despite higher ticket prices, the actual volume of consumer transactions is contracting. We mapped out how the $18 billion SRS and GMS acquisitions are transforming neighborhood stores into commercial hubs. And we detailed the mechanical impact of the GSE liquidity mandate on the broader housing freeze.
It really highlights why relying on headlines is so dangerous. But I want to leave you with one final provocative thought to consider, something that builds on this entire B2B wholesale pivot.
Let's hear it.
If Home Depot's strategy is successful and they manage to completely corner the commercial wholesale market during this housing freeze, integrating everything from architectural roofing to commercial drywall into a single AI-driven sub-3-hour delivery network, how will traditional independent mom-and-pop contractors adapt?
Oh, wow.
When the housing market inevitably unfreezes and demand skyrockets, will those independent contractors find themselves forced to rely entirely on a centralized retail distributor monopoly that dictates pricing and supply for the entire industry?
That is a fascinating and potentially ruthless dynamic to watch unfold. We stepped deep into the mechanical realities of retail accounting and macroeconomic policy today, and hopefully we gave you the tools to see past the headline illusions. Thank you for joining us on this deep dive. Keep asking the hard questions, keep auditing the footnotes, and we will catch you next time.